All central banks have a keen interest in healthy and efficient capital markets. Capital markets provide an important channel of financing for the real economy, they help allocate risk, and they support economic growth and financial stability. In an effort to promote strong capital markets, the CGFS has produced this important report, which summarises recent trends in capital market developments in both advanced economies and emerging markets. It identifies factors that make capital markets more robust, and importantly, it makes recommendations to policymakers seeking to strengthen their domestic capital markets.
Three trends characterise capital market development over the past 2 decades. First, large differences persist in the size of capital markets, shown by the vertical black lines. Second, emerging economy markets, shown in red, have been catching up with those in advanced economies, shown in blue, but the gap has not yet closed. Third, fixed income markets for corporate and government bonds have been catching up with equity markets. Drivers of market development can be grouped into those that determine the enabling environment and those more linked to specific capital market functions. One element of the enabling environment is the quality of the regulatory regime. As you can see in the graph, capital markets are larger in economies with better rated market supervisors. Another driver of development is that markets are larger in economies with more savings managed by institutional investors. Emerging economies allocate less savings towards such investors. They tend to cluster at the left of the graph, while advanced economies to the right. Capital market functioning also depends on an ecosystem of efficient trading systems, complementary markets, and market infrastructures. On the left, results from the report's survey of market participants shows that there are strong complementarities between derivative market depth and cash market liquidity. On the right, the survey also shows that cash market liquidity premia are lower in markets with safer and more efficient settlement and clearing infrastructures.
I'd like to highlight 2 recommendations from the report. The first is to strengthen the independence and the capacity of regulators. Independent market supervisors are vital for well-functioning capital markets. They need adequate resources to identify problems when they occur and sufficient powers to tackle any problems. The second recommendation is the development of a diverse investor base. Having a variety of institutional investors can boost capital markets. Domestic investors like pension funds, insurers and mutual funds help ensure markets are deep and liquid. So too can international investors, who can also promote higher standards.